In a stunning revelation, one of the largest banks in the United States was suddenly forced out of business. Silicon Valley Bank, otherwise known as SVB, was a top 20 largest bank holding over $342 billion of client funds, and they suddenly became insolvent in a matter of days. It's really important to realize that, generally speaking, this bank was not struggling. It was a profitable bank, and many financial gurus were saying how wonderful the company was.
Ninth best performer year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank.
Now, we can debate how accurate many of Jim Cramer's predictions are, and if you have a favorite prediction of his that didn't plan out successfully, I'd love to hear about it down in the comments. But it wasn't just Jim Cramer. Forbes had just recently named this bank one of the top banks in the nation, but the whole point of this is that people generally thought that the bank was doing okay. So how did it go from being okay to being forced to close its doors in a matter of days? Well, the short answer is it was a good old-fashioned bank run. A bank run is when a large number of people begin to suddenly withdraw their deposits from the bank all at the same time. This is problematic because the bank doesn't keep your entire deposit readily available for withdrawal. Instead, they take some of your deposit and they keep some of it as reserves, and then they invest the rest of it, which is how banks ultimately make their money. Banks loan out your deposit to other people who are trying to buy a car or buy a house, maybe start up a business. Usually the amount held in reserves is more than enough to handle any withdrawal requests. And there are mechanisms in place where banks can obtain very short-term loans from other banks or the federal treasury itself. And usually not everyone wants their money all at once, so bank runs are very rare. So what caused this particular bank run? Well, the first thing that we need to realize is that Silicon Valley Bank was a very specialized niche bank. They didn't really serve regular people like me and you. Instead, they provided financial access to the Silicon Valley startup tech companies. New tech companies usually obtain funding from various venture capital groups, so even though they're a brand new business, they often have millions or potentially even billions of dollars worth of funds from these venture groups. But even though these new companies have a lot of cash on hand, most banks actually don't want to provide services to these startup companies because they don't have any revenue. They barely have a few months' worth of accounts to their names. There's a wide variety of reasons, but banks don't want to give them access to the complex financial infrastructure that these companies require in order to conduct their business, such as doing payroll and everything else. And that's where SVB stepped in. They helped these startup tech companies that other banks didn't want to work with simply because they were new. So SVB had a relatively small number of total clients, but each of their clients had millions or potentially billions of dollars stored at these banks. So that's the first key factor to understand. They had a small total number of clients, all of whom kind of knew each other as they all worked in similar tech startup companies. And the second factor that started to become an issue was that these venture capital funds were getting harder and harder to secure. As the economy slowly began contracting due to rising interest rates, it became harder and harder for these companies to secure new loans. And so they naturally had to draw down some of the balances that they held in SVB Bank. If you can't get a new loan, your only option is to spend the money that you already have, which was the money in SVB. So there were natural outflows from SVB. Those balances were slowly draining. Now, here comes the third and final nail in the coffin. SVB had invested heavily into US bonds, which are historically one of the absolute safest types of investments you can possibly hope for. Now, you might be wondering how a safe investment can be a bad thing. Well, For a long time, interest rates were at historical lows, hovering near 0%. SVB Bank held billions of dollars worth of bonds that were only paying 1.79% interest rate. Now, with most bonds, you need to hold on to them for a certain amount of time until their maturity. However, you can sell them on a secondary market at pretty much any time you want. But now that interest rates have risen significantly, who is going to want to buy a bond that only pays 1.79% when they can go out and buy a new bond directly from the government that pays out 5%? Think of it this way. If you bought a $100 bond that pays 2% interest, by the time next year comes around, that bond will now be worth $102. But I want to buy a new bond because it pays 5%, so I'll earn $5 instead of the $2 that you will earn if I just simply go and buy a new bond instead of buying yours. So if you want to sell me your bond, the only way for you to entice me to buy your bond instead of just buying a new one is if you sell your bond for less than it's worth. You have to sell me your bond for $97 or less. That way, if you sell it to me at $97 and next year it's still going to be worth that $102, then I still made a $5 profit that I was after. But the problem is that you bought it for $100 and then just sold it to me for $97, which means you just lost money. And that was what was happening. As their clients were slowly withdrawing funds from the bank was forced to start selling these investment bonds for a loss. Last Wednesday, they announced that they had sold a bunch of these bonds for a loss. And in addition to that, as a double whammy, the bank said that they were going to be issuing additional shares of the bank and selling these shares to shore up their finances. So between selling assets for a loss and then creating shares of this bank out of thin air and selling them, diluting the existing shares of the marketplace, these startup companies became panicked. Now, it's important to remember that the government only insures up to $250,000 worth of deposits in FDIC insurance. So if you have large sums of money in a bank that fails, that money is just gone. So these guys spook easily when they've got millions or billions of dollars chilling in a bank. And so the tech world is a small, tight-knit community. And so people quickly began talking to each other, and this fear and panic spread. And within days, everyone was scared and wanted to withdraw their money, sealing the bank's fate. So there was no gross negligence, risky subprime investing behavior, or outright fraud. Instead, it was a series of relatively simple events working together in unison to cause one of the largest banks in the United States to fail virtually overnight. So I don't think that this is necessarily an indication of a broader contagion in the market that will suddenly cause additional banks to fail. I don't think this is the first domino in a series of additional bank failures. However, there will still be plenty of painful ripple side effects as these tech companies no longer have a place to do banking that is willing to meet their unique needs as a startup company. And as a result of this bank failing, a lot of the other smaller regional banks were hit brutally on Monday when the stock market opened. Many of the smaller regional banks lost 60% of their value overnight as worries of this contagion spread that it might infect some of these other smaller banks. Thankfully, the government has stepped in and said that they will take care of these depositors at SVB, but it's still something that we need to be wary about. But let me know your thoughts. Is it going to get worse? And if so, how bad do you think it'll get? Leave a comment down below and let me know what you think. And if you enjoyed this video, consider subscribing. And as always, I'll see you all again next time.